In recent years, the word debt has got a bad reputation. But the truth is that not all debt is bad. In fact, some sorts of debt can be beneficial. Going a step further, good debt is one of the greatest methods to begin leveraging the power of your money and creating passive income streams that will assist you in developing genuine wealth. Without that, very few people would own a house or be able to use their high earnings to start building their empire. And today, I'm going to show you how wealthy people use debt as a tool to expand their empire. Number 1. Stock shorting / hedge funds. People like me and you try our best to predict which companies will grow and rise in value and invest the money we work so hard to earn in hopes that these companies will grow. But hedge funds often use a completely opposite strategy. They try to make money when companies fall or go bankrupt, as it was the case of GameStop. But how do hedge funds make money with debt? Consider a trader who believes that the price of XY stock, which is currently trading at $50, will fall in the following months. They borrow 100 shares and sell them to another investor. The trader now is short 100 shares after selling something they did not own but borrowed. The short sale was only allowed because the shares were borrowed, which may not always be possible if the stock is already severely shorted by other traders. A week later, the company whose stock was shorted reports shockingly bad quarterly financial results, and the stock falls to $40. To replace the borrowed shares, the trader decides to close the short position and buys 100 shares on the open market for $40. The trader's profit now on the short sale is $1,000. But you can already think of the risks here, because if the shares rises instead of falling, then you have to pay the difference for which you borrowed the share and the increased price out of your own pocket. And since theoretically a share can rise infinitely, you can also lose an infinite amount of money. But I think it's obvious that only the big boys use that strategy since it's very risky. Number 2. Most trade is built on debt. This may sound weird because borrowing money to establish a business is a bad idea. But there are some enterprises, particularly conventional enterprises, where this is your best alternative. Let's say you want to sell sports bottles. It's a very common product with a lot of demand. Ideally, you would fly to China, find a factory that makes those kind of bottles at a reasonable price, buy a container of them, ship them to your country and distribute them to your customers. But nowadays, that's mostly done online through websites like AliExpress. But here's the catch. You don't have to pay for the products in order to have them. But let me elaborate further. In the last few decades, China has become one of the world's largest factories producing everything. Thousands of factories work non-stop to produce everything that the world demands. And in order to make it easier to sell, most of these factories would gladly loan you their products in exchange for a future payment. But that's how business has been done for decades. When a customer sells a product in any country around the world, he pays the manufacturer and borrows more things. You're basically telling the factory, you make it, I sell it, and if I can sell it above your price, that's going to be my profit. This method is wonderful because you are not tying up your own money in this transaction, which is why selling is one of the most important abilities you should learn. Number 3. Forex. The foreign exchange market is a market where currencies are traded. It enables international trade. For example, you can't use US dollars in Turkey. You have to buy Turkish lira to pay your employees in Turkey. So there is a market where anyone can buy foreign currencies, and these currencies fluctuate due to various factors. When the Federal Reserve System, which is by the way similar to the European Central Bank, raises interest rates, the supply of dollars in the market becomes limited, and the US dollar's value increases against other currencies. However, simply raising interest rates to make the dollar the strongest currency does obviously not work that way. Because the money becomes more expensive for American banks as well, who offer the money to the end customers, who are real citizens and businesses, for an even higher interest rate than the Fed. Which means that almost no one would take loans because the interest rate is too high. So it would be like a product that no one wants because it's too expensive, to put it simply. But if you can predict which currencies will rise or fall, you can make big money in this economy. Number 4. Mortgage refinancing. When you refinance your mortgage, you obtain a new loan to replace your old one. If you can refinance into a loan with a lower interest rate than you now have, you may be able to save money on your monthly payment and interests throughout the life of the loan. You may also be able to benefit from a cash-out refinance, which allows you to use your home equity as a low-interest loan. How to set up refinancing. Set a specific financial goal. There should be a compelling reason for the refinancing, whether it's to lower your monthly payment, shorten the duration of your loan, or access equity for home improvements or debt reduction. Examine your credit score and history. You will need to qualify for a refinancing just like you would for initial home loan. The higher your credit score, the better the refinancing rates lenders will give you, and the more likely underwriters will approve your loan. Determine how much equity you have in your house. The entire worth of your property less the amount owed on your mortgage is your home equity. Check your mortgage statement to discover what your current balance is. Then, use online house search sites or consult with a real estate professional to get the current estimated worth of your home. Rate and term refinance versus cash-out refinance. What's the difference? A rate and term refinance occurs when you refinance to reset your interest rate or term, or to transfer from an adjustable rate mortgage to a fixed rate mortgage. Rate and term refinancing pays off one debt with the profits of a new loan, all while using the same property as security. This enables you to cut your interest rate or shorten the duration of your mortgage in order to develop equity faster. Cash-out refinancing, on the other hand, provides you with more cash than you need to pay off your existing mortgage, closing costs, points, and any mortgage liens. You can spend the money whatever you like. To be qualified for cash-out refinancing, you must normally have much more than 20% equity in your house. That's it. I hope you reach your goals, and thanks for watching. See you in the next one.